Ja, wir befinden uns hier in Frankfurt mitten in der City. Manche sagen dazu Bankfurt, eine Weltmetropole des Investments und des Geldes, kann man sagen. Aber auch immer mal wieder Schauplatz von Menschen, die sich über alternative Investments austauschen. Zum Beispiel auch über die Rohstoffmärkte, die in den letzten Jahren ja durchaus im Fokus waren. Und wir befinden uns hier auf der Goldmesse. Man kann im Prinzip sagen, es ist eine Möglichkeit, hier mit Experten aus verschiedenen Bereichen zu sprechen. Und einer dieser Experten sitzt jetzt hier mit mir am Tisch. Sein Name ist ruhig. What's your name properly pronounced?
Rick Rule.
Rick Rule. Okay. So your ancestors, they came from Europe, maybe?
Caucasian, sure. I'm a European mongrel.
Okay.
My ancestors came from many parts of Europe, including Germany.
Okay, so you have some roots here on the old continent. So welcome to Frankfurt.
Thank you. It's been, I was last here in 1980, so obviously the city's changed some.
So in the golden 80s, sometimes I was a young boy then, and so you come back now in a total different environment. But we are happy that we can have you here, and maybe you can share some comments about what you brought here. What have been your expectations to come here, and did these expectations, were they met here in Frankfurt?
The German retail audience is the second largest retail audience for gold equities in the world after the US. There's a larger German participation in mining equities than either Australia or Canada, which are generally better known for mining. But the German audience is in fact the second largest audience in the world, well established in this industry. Traditionally, I've talked to the German audience through Switzerland. The host of this conference, Kai Hoffmann, invited me to Frankfurt to address the audience directly in Germany, and I was delighted to come.
So you are frequently speaker in front of audiences like this. So this is it's not unusual for you. You are in a position where you have meetings like this a lot of times.
That's correct. I've addressed German-speaking audiences for years in Switzerland and Austria, but I guess I'm too lazy to have come to Frankfurt of my own volition. So Kai assisted me.
So thank you, Kai, that you brought this man to us. So what was your first encounter to the metal markets and to the mining industry? What was your first approach to that? How old were you?
I decided that I would be in natural resource finance. I'm embarrassed to say when I was 16 years of age, so very young. I guess that makes me a very dull man. I'm 72 years of age, and I'm still pursuing the vocation that I adopted at age 16. In the decade of the 1960s in the United States, there was two things. I like to be out of doors, and so I was attracted to agriculture and oil and gas. And I learned enough about the oil and gas business, sedimentary geology, that it was hard for the hard rock guys, the mining guys, to lie to me. Which was a good attribute. It was also, it was apparent to me in the late 1960s that one part of American hegemony was ending. Although I was a young man, I understood that certain parts of the US system were unsustainable arithmetically. Strange parallels with today that we can deal with later. And as I studied as a young man, not knowing very much, it occurred to me that the US dollar, and probably other currencies, but I didn't know about them then, were going to decline in purchasing power through the decade of the 70s, which is what happened. I had no idea the extent of the decline, and I had no idea the extent of at least the nominal increase in the gold price. For those of your listeners who are young, in the decade of the 70s, the US dollar lost 75% of its purchasing power, and the gold price went up 30-fold in 10 years. It was a very, very precipitous bull market, and it was a formative event.
We just published a couple of months ago an article which was reminding the people what happened in 1971. And a lot of Germans, they forget, or they never knew. The Danish generation, they don't care. So in your words, what would you say? I mean, you started going into these issues when in the 60s, so you were alive when this happens,
Yes.
71. So what was happening in 71, and did you really have you been aware what effects this will have to the future of your generation and the generations to come?
I would say that three things happened in 1971. And understand, I'm going to answer this question from an American perspective rather than a German perspective. But in 1971, in the United States, they deregulated the price of gold. The price of gold in US dollars had been established by Congress, and private gold ownership for Americans was illegal after 1933. In 1971, they legalized gold ownership and they removed the price cap on gold. What began happening really as early as 1968 is that many of our European trading partners, but particularly the French, looked at the US budget and came to understand that US spending, both in Vietnam and on social programs, was unsustainable. And our European trading partners, who had built up fairly large reserves of US dollars, began to exchange those reserves for gold, in particular the French. The US government, understanding that this was unsustainable, suspended the gold window, despite our promises to our US partners, for our European partners for 30 years, that the dollar would always be convertible to gold. President Nixon said to our European partners, we lied. Strong letter to follow. The third thing that happened is that inflation had begun to become a social and political issue in the United States even as early as 1967. But the impact of inflation is cumulative and compounding. In the early stages of inflation, people had other concerns because the lifestyle in the United States in the 60s was very good. But in the period 1967 to 1971, despite the low official inflation statistics, the real inflation statistics around the price of food, around the price of gasoline, around the price of rents, around the price of health care, became so apparent that the average working person came to understand that rather than their living standards increasing over time, which was the American expectation, they were deteriorating. Those three things, the deregulation of the gold price and legalization of US ownership, the suspension of convertibility of the US dollar into gold, and the realization of the pernicious impacts of inflation kicked off a tremendous bull market in gold.
So there was, of course, some people who profited from that, but inflation in general speaking, we would say in those early days, it was like a robbery. I mean, the people lost who kept the dollar and who kept the fiat currencies, they were robbed. I mean, this is like putting heavy weights on a lot of shoulders and hoping that a lot of shoulders will not collapse.
According to the Office of Management and Budget, which is to say, according to the US government, not me, in the decade between 1970 and 1980, the absolute purchasing power of the US dollar declined by 75%, meaning that at the end of the decade, it took $4,000 to buy $1,000 worth of goods and services at the beginning of the decade. So a saver, somebody who invested in long-term bonds or treasury securities, lost in 10 years 75% of their purchasing power, pre-tax. A truly ugly time.
Yes.
It should be noted that that's absolute deterioration of the US dollar. Savers in many other currencies did worse.
So we say in Germany, sometimes we have like a rhyme. We say history never repeats itself one to one, but it is always rhyming. It's always in rhymes. So what if you just compare those early days of your life and your career to today, what would the parallels be? What is comparable and what is not? What is new?
The parallels are strangely similar. Coming into the 1970s, we came out of 25 years in the US that had been spectacular. Although World War II was costly for us, it was devastating for you. We had 25 years of American hegemony beginning in 1945, arguably ending in 1970. And confidence was extraordinarily high. So high that people were ignoring the warning signs of government expenditure and of the increasing government take, which robbed the private sector of the capital to re-expand and build the American dream. 25 years of good times, I would suggest, blinded the American citizen to the fact that there was going to be a reckoning for those 25 years of good times. Fast forward, beginning in 1982, after America's crash, going probably to 2022.
So the crash, you would say, between 78 and 82,
I
or
mean, the real American crash was 1979 to 1982. 18% interest rates.
Okay.
You know, I mean, we had a man, President Reagan, who came in. He didn't cut government, but he cut the increase in growth of the government, and he allowed the private sector to grow. At the same time that Paul Volcker came in, raised the interest rate to match the rate of inflation, and killed inflation. Killed inflation. Also restored the United States dollar to the world's reserve currency. Our nominal and real interest rates were much higher than Europe's. So European money from around the world flowed into the US. The consequence of that is that from 1982 to 2022, that we had another period of American hegemony. Falling real and nominal interest rates, a very strong US dollar, so that we could export our sins to you.
Thank you.
But we also had wonderful demographics. The baby boomers coming of age, earning, working, the growth that happened as a consequence of that, the good parts of globalization, the internationalization of labor, the introduction of hundreds of millions of women to the labor force. All of that led to a tremendous economic boom. I would suggest to you that epoch, that beneficial epoch, ended in 2022. And I think that the lag time for public awareness is so similar to the lag time between 1967 and 1971. The lag time between what I would suggest was the cresting of the American epoch, and today is strangely similar. I believe that very much like the 1970s, in the decade in front of us, the 10 years in front of us, that the US dollar will lose 75% of its purchasing power in absolute terms. I don't think it'll lose ground relative to the euro. I think in an absolute rather than a relative sense, it will lose value. And I think that what that means is that the next 10 years are going to be much more challenging for everybody than the last 40 have been.
That was my question about this 75%, because I've heard you that you said the next 10 years you will possibly see a decline of the US purchasing power of 75%. And you now said also that it's more critical, or you think it might be more critical. What do you mean with that? What can this mean for the average person? How can they save from this critical time by themselves, depending on a normal average working people?
Just maybe just imagine you would be 16 years old now. My youngest boy, my youngest son, he's 16. And if he comes to me and says, "Dad, what can I do?" And I would like to come back to him. I met a guy in Frankfurt who, when he was 16 years old, he just realized there's something very strange happening in this world, and to have and just imagine you have maybe some dollars or euros to spend, and yeah, what would be your suggestion for him?
The starter is in the decade of the 70s, where the US dollar lost 75% of its purchasing power, the nominal price of gold ran 28-fold. I don't believe that gold is going to run 28-fold in the next 10 years, but I do believe that the nominal price of gold will increase commensurate with the decline in the US dollar, which means arithmetically, I suspect that in the next 10 years, the gold price nominally in US dollars increases 3 or 4-fold.
Okay. So 3 to 5 times more value than today.
Yeah. Maybe I'm wrong. Maybe it's 2.5. But, you know, this is like horseshoes and grenades. You get close, right?
Okay. So golden times for investors in golden stocks also. So because if the price for gold increase, of course, also this would affect the mining sector.
It's important to note that there's sort of 3 categories of gold investment. One is physical gold, and you own that for savings. You own it to maintain your purchasing power. It's really an insurance policy. You own it, and if you're smart, you pray it doesn't go up, because of the set of circumstances that makes it go up makes the rest of your life less pleasant. The second is an investment account. And in an investment account, you own the very highest quality gold companies. You don't want to take any operational risk. Traditionally, in the 1970s, the best of the best gold companies generated price performance that was twice the increase of the price of gold, which is to say, while gold increased 30-fold, the best of the best gold stocks increased 60-fold in 10 years. It's reasonable to believe, I think, that if you think the gold price goes up 3-fold in the next 10 years, that the best of the best gold stocks will go up 6-fold. But there is some risk. And then there's this conference, which are the speculative juniors. This is not investment, it's not savings, this is speculation. You have to do hard work, you have to tolerate volatility, you have to tolerate cyclicality, and you have to be prepared to make mistakes. In the decade of the 70s, from the best data we have, a well-selected portfolio of gold juniors escalated at 4 times the rate that the gold price escalated. I remember very well, just to personalize it for your audience, in 1970, a little tiny silver producer called Coeur d'Alene Mines could be purchased for 10 cents a share. In 1980, that same share sold for $65, which will tell you something about the returns that accrued to people who were able to take intelligent risk. Most investors, sadly, aren't willing to work hard enough, and they aren't willing to tolerate the volatility and the cyclicality in gold. But for those who are, conferences like this are a very interesting venue.
So coming back to my 16-year-old son, I would say, okay, maybe he has 1,500 euro, which he could invest in physical gold. 1,500 he could invest in a very renowned gold mining company, and 1,500 euro he could invest maybe in a startup like Banyan Gold or something which is more volatile, more risky. But in general, he would like have a balanced portfolio from the start, from the scratch up, and maybe having also something for the future. Maybe later he will remind back and, oh yes, I was living in this time and I took those decisions, and maybe he's coming up in some years and he will think like, maybe he will feel like you feel today.
I'm going to give your son very boring advice. The first thing that I would ask your son to do is invest in himself.
Okay.
In his education, in his character. The thing that will serve him the best in his life, much better than gold, is to be a person who adds more value to other people than they consume from other people. The delta between what you produce and what you consume is called savings. And without savings, you never develop capital. Without capital, you never become a capitalist. And without becoming a capitalist, you're never solvent. So the first thing that your son needs to do is determine what it is in his life he's going to do to create value. The second thing, I'm sorry, this is very boring, but it's very true.
It has to be told, yes.
The second thing that your son needs to
At the moment, you're speaking about my older son. He's in that that portion. He's there. So the younger not.
The second thing that your son needs to do to prepare himself to invest is to read 4 books. They're all available in German. One was actually written in German, the best. And they are, in order of sequence, Economics in One Lesson, so that your son can learn about the way the world works, not the way his teachers wished it worked. This was not written by Angela Merkel, right? This was written by a guy named Hazlitt. The second book he must read is The Intelligent Investor by Ben Graham. This is the man who taught Warren Buffett, a very good student. It's important that he just not buy the books. It's important that he read them. You know, the third book, if he found Intelligent Investor interesting, the third book that he must read is Securities Analysis, which teaches you how to invest. It teaches you that the market isn't a subject, it's a facility for buying and selling fractional ownership in businesses.
So we will link these 3 books below the podcast.
Right. And the fourth is Human Action by Ludwig von Mises.
Okay, 4 books.
Yes, 4 books. 4 books. Human Action, when you read it, explains why the first 3 books are true. It talks about how people think, how they act individually and as groups, what their motivations are, how you add utility, how you consume utility. If your son reads those 4 books, and if he applies the lessons in those 4 books, he will A, become rich, and he will B, become a good person, which is a wonderful combination. Now I'll answer the question.
Okay.
If your son had 1,500 euros to invest, I would ask him, first of all, to save systematically so that he didn't end with 1,500 euros. He began with 1,500 euros. I would ask him, because he's a young man, to only have 10% of it in gold. So 150 euros in gold. I would ask him to have 200 euros in euros, short term, so that he had liquidity, so that he would have the ability to take advantage of illiquidity in other times. If you have cash when others don't, and you have the courage to act when others are afraid, you can make unusual gains. But if you don't have the cash, you don't have the tools, and certainly you won't have the courage to take advantage. But this is contradictory advice, because the cash interest that he'll get on his euros won't keep pace with inflation. It's a negative savings, but if he considers the negative savings to be an options payment on having liquidity when others don't, he'll come to understand the value of that. If he's willing to do a little work, I would ask him, because he's young and can take some risk, to put 10% of his money in the best gold stocks, the very high quality, Franco-Nevada, Wheaton Precious, Agnico Eagle, and to not look at them for 5 years. Mercifully, he gets a good dividend from those, probably approaching the income that he gets from his cash holdings. If your son is willing to work, really work, and if he's willing to tolerate 20-25% volatility, he could speculate with as much as 10% of his portfolio in the juniors, but only if he's willing to work. I would suggest to your son that he can own the same number of stocks as corresponds with the number of hours per month he's going to spend studying his stocks.
Okay.
If the answer to that is no hours, then he could own no speculations. If it's 10 hours, he could own 10 speculations.
So you have to actually work on the markets to go in these corners.
Not just the markets, you have to work on the companies. You have to read the annual reports, the quarterly reports, the resource statements, the proxies. You actually have to do the work. Most people in this conference hall, their investment strategy is got a hunch, bet a bunch. And it's why they lose. People pay slavish attention to the price of these stocks without having any opinion as to value. The information around price is of no concern if you don't have an opinion as to value. But the value is hard to get.
That's the work a lot of people are not willing to do. So they try to find some experts who are doing the work for them, and then they are disappointed because the experts, they're maybe not deserving the known expert. so that's a problem.
Probably 200 people at this conference will ask me my opinion on a stock, not understanding that something could happen next week or the week after, which would change my opinion. If they bought the stock because I said so and they don't have access to my opinion week after week after week, which they don't, it's a very poor reason to buy the stock.
Okay. Wow. So we have to go up there again, yes?
No, it's only we spoke about half an hour.
Yes.
We have now 5 minutes.
Okay. Thank you. So, do you have any more questions? Because otherwise, I would finish the interview.
I have always questions.
You have another question.
I see tremendous currency decline all over the world, especially in the West. And this leads us possibly to these wars all over the world, in Ukraine, in Gaza, and wherever. I'm not sure what happened, especially what happened if the wars will be finished. If the war, for example, will be finished in Ukraine, I'm not sure if you can answer this, but what does this mean for the money flow, for the currency, especially in the West? And is then there this end of the European currency, and then we have a world crisis?
I'm not a currency expert, and my earlier comments were mostly around the US circumstance because I'm American. When I look at the euro, I think your structural difficulties are at least as severe as ours. When I look at the pension crisis in Europe, when I look at the deterioration in the German economy, which I have always believed, perhaps incorrectly, but I've always believed it to be the pillar of the European community, I actually suspect that the euro will decline even relative to the US dollar. I think people in Europe have an advantage over Americans in that you're much less ethnocentric. Europeans have invested throughout Europe and around the world, and Americans mostly invest in the US because we've had enough opportunity that we haven't had to. So I think that the individual European probably has the schooling and the temperament to diversify his or her savings in a way, if they do it, so that not all of their savings are denominated in euros. I think, too, that individuals who invest in themselves and their skill sets, people whose lives generate more savings, and people who generate utility for other people, will get through the next 10 years fairly well. The average person, unfortunately, who believes that the next 10 years will be like the last 40 years, will get through the next 10 years, but it would be much less pleasant for them. I would just ask your listeners to look at their budgets and look at their savings and look at the amount of money that they will need to spend over the next 10 years and ask themselves how they will fare if the purchasing power of their savings declines by 75% over the next decade. It's important that when your listeners consider this, that their response isn't panic or curling up in the corner in fetal position and crying. Because if you don't try, you'll lose for sure. You'll lose for sure. It's important that people look at their budgets, they look at their plans, they make a plan, and they begin to take action, cutting their expenses if need be, supplementing their income if need be, changing their investment outlook as need be, because I really truly believe that the next 10 years will survive them, but not as easily as we survived the last 40. For most people, they believe that past is prologue, and I believe that the arithmetic of the excesses that all three of us have enjoyed in the last 40 years will be paid for in the next 10.
So this is very good ending sentences which you said, because it
I have ending
you have an ending sentence. Okay.
Every crisis is a chance.
No, because like you were like coming from the point that we have to invest in our own mindset, and if we have 40 good years, or we had 40 good years, maybe some of us, they were not really forced to use the minds and the heart. So now we have to have mind and heart, and of course somebody who wants to take action. And this is not passive. This is not like going into the corner and crying and say, oh, this is a bad, why do I have these bad times? Why, my Lord, do you punish us so hard? It's like we had a party, and every party ends at one day. So, and just prepare for the ending of the party, and just be in a good faith that you and your skill set will take you also through hard times. And this is a very good message from you, also especially for the younger generation. And this is why I would really personally want to thank you for these statements.
A pleasure. Thank you for the opportunity.
Thank you for having us here to asking some questions.
Thank you.
Thank you so much.
Hopefully they'll like
Very good. Yes. Oh, you're perfect.